Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. The webinar title today is CAGR, how savvy investors use it in stock investing. My name is Shane Chu. I'm the moderator for this session. Now, I'm not sure if many of you here have heard of the term CAGR, and is commonly pronounced as CAGR in Malaysia. All right. So it stands for compound annual growth rate. And today, our speaker will walk you through what exactly is compound annual growth rate, what are its uses, and what kind of stocks you can apply CAGR, and what kind of stock you cannot apply CAGR, right? So, and we'll go through some case studies. All right. So as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He's the content producer on kclau.com. He has written 290 over articles in relations to finance and investment, and he's also a regular webinar host and presenter. He is the co-founder of DividendVault, where he transformed newbies into investors who can build dividend portfolios independently via education. He himself is a dividend investor where he gained about 2 to 10% dividend yield per annum. So, ladies and gentlemen, may I present to you Mr. Ian Tai. Ian, how are you today?
Hello, Shane. Hello, everyone. Good evening to all of you. Doing fine here. Hope the same for you too, Shane.
Yeah, great to you back in our 2024 Bursa webinar. So I will just stop sharing my screen and hand over the control to you.
Fantastic. All right. First and foremost, thank you so much, Shane, for your kind introduction. Always a pleasure to be here to actually present or to share a little bit of my journey as an investor to you guys. So today we're going to talk about CAGR or CAGR, and I have prepared a lot of materials, and let's get into them right away. So let me just quickly share to you my screen. So this is actually the slides for today. But before that, guys, do me a favor. If you are looking at this presentation, all right, through your laptops, right, what you can do is that you can open a tab. Okay, so you have a Google bar like this. What you can do is that you can just type in CAGR calculator, and you will get actually a CAGR or CAGR calculator. Just make sure that you have this page, stand by this, and yep, that's about it. Later, we're going to use this very extensively, all right? And with that, let's move on to my slides. So today, we're going to have the following webinar outline. There are 4 themes for today's webinar. The first one is actually what is CAGR and how to calculate it. Number 2, I'm going to share with you examples of stocks where CAGR can be calculated and applied. And then the third one is that after we have actually calculated CAGR, personally, I use CAGR first, then I will actually use this to calculate PEG ratio, okay? And with that, I'm going to also share with you how savvy investors use this ratio to value a stock. And last but not least, I'm also going to share with you examples of stocks where CAGR cannot be applied. So guys, today's session is going to be a little bit heavy. So if you have any questions along the way, feel free to put your questions in the Q&A box. All right. I'll be happy to address them right after this sharing session. So the first one, what is CAGR and how to calculate it? So CAGR stands for compound annual growth rate. So what does it do? What does it calculate? Well, let's go through some maths together, okay? So with that, for convenience sake, I'm going to just make the slides like this so that I can actually, use the calculator and present it with the slides like this concurrently, all right? Hope that is actually okay with you guys. So let's go through this simple question over here. Question. what is your CAGR of this investment after? So let's assume, and you are given 10,000 ringgit to invest into something. So this will be your initial capital. After 1 year, your investment value, the value of your investment has actually grown to 11,000 ringgit. So starting at 10, now you ended up with 11,000 ringgit. Okay, from this investment. Type in the chat box, let me know. All right. So Ahmad Azri says 10%. Yes, that is actually correct. It's very simple, right? So it's just 10,000 ringgit, you get 10%, therefore you will end up with 11,000 ringgit. So it is actually used this way. So the starting value is actually 10,000 ringgit. Your ending value after 1 year is 11,000. The number of periods is 1 year. So if you want to compute the growth rate, or should I say the compound annual growth rate, but there's only 1 year, right? So you just click onto the button here. And there you go. You have 10%. Okay, your growth rate will be 10%. That's how you use the CAGR calculator. All right. Now, with that, let's move on to the next one. So it is 10%. Next, what about this case? Okay, so just now it was too easy. But now let's say from year 1, okay, moving on from 11,000, then another year passed by, you still hold on to this investment. And right now, it has actually grown by 20%, and you ended up with 13,200. Okay, so from here to here is 10%. From here to here is 20%. But what is the compound annual growth rate that you are going to get if you are actually starting from 10,000 and after 2 years later, you ended up with 13,200 ringgit. So what is the compound annual growth rate for that 2 years? All right, anyone can make a guess? It is definitely not 32%. Okay, so some of you have actually calculated, all right? And some of you are actually getting the correct answer. It is actually 14.89. Now, I'm going to just go and use back the calculator to share with you, and I'll explain the context of it. So in order to calculate the CAGR, in this case, what you do is that you are starting off with 10,000. So 10,000. Your ending value after 2 years is 13,200. The number of periods is 2 years. So if you click onto the calculator button, there you go. You have 14.89%. Okay. So Huang, you actually got it correct, which is this 14.89%. Right? So you may actually do this. So what does this 14.89% means? It means to say that in these 2 years, starting from 10,000, if you plus 14.89% for first year, and from there you plus another 14.89%, by year 2, you should be able to get 13,200 ringgit. Okay? So that is actually what it means. Now, let's move on to another situation, okay? So let's carry on this story. Question: what would your CAGR be of this investment after 4 years later? So which means moving on from year 2, which is 13,200. The following year, you kind of like, from here to here, it's a capital loss. There's a slight dip in your investment value. It dropped from 13,200 down to 12,144. Then subsequently, plus 15%. And right now, you ended up with this value, which is 13,966. Okay, guys. Time for time for some homework. Can you actually calculate for me what is the CAGR of this investment after 4 years? Let's see what answers do you get. So Ahmad Azvi says for 8.71%. John Yap says 8.7%. Okay, that is actually very good. So let me just carry on. So let me just review to you the answer. Yes, the answer is 8.7%. So how do you get 8.7? It's really, really simple. Just put in starting value, and then you kind of like put in the ending value, which is how much? 13966, 13966. Number of periods 4, and bam, you got 8.7%. Okay, so can you see that this year-on-year growth, every year is different. +10, +20, -8, +15, this kind of thing. It seems to be very erratic on a year-on-year basis. So CAGR is actually calculated to see overall from here to here, what's my compound annual growth rate? And the answer is 8.7%, which also means starting from year 0, which is 10,000, if you plus 8.7, 8.7, 8.7, 8.7% every single year, you compound it that way, by year 4, you will be ending up with 13,966 ringgit. Okay, so that is actually how you do CAGR. All right, and a lot of you guys are actually now very, very much an expert in using the CAGR calculator. Congratulations. All right, and this is actually the whole context of using CAGR. And with that, let's move on to the second part of this sharing session, where we're going to talk about example of stocks where CAGR can be calculated and applied. So there are two ways. There are basically a few places where you can use it, but most likely you can actually use CAGR. You can actually calculate the CAGR of a stock's earnings and as well as stock price. Okay, and let's get into them. So there are 3 steps. If you want to calculate CAGR, there are 3 steps to calculating the CAGR of a stock's earnings. Okay, and let's get into the 3 steps. And with that, let's do a case study. Let's call this A Berhad. So this is A Berhad. Step number 1 to using CAGR. So now the purpose of using CAGR, let me give you the context. It is not so much to trade. It is not so much to speculate. Here, whatever I do here, whatever is being presented here is always being presented in the context of a long-term investor, which means to say we are buying into businesses. We are keeping businesses and hope that these businesses can continue to be not just profitable, but it can use their profits to actually expand their operations and keep on growing their earnings into the future. Okay, so it's not so much about buying and selling, but it's more like buying and hold on to them for the long term. Okay, so that is actually the context of using CAGR. All right, that's the purpose of using CAGR. CAGR doesn't really matter too much if you are trading or speculating. But if you ask me about trading or speculating, I wouldn't know lah, because I'm not a trader, not a speculator. Okay, so if you are looking into CAGR, the first thing that you need to make sure of a stock is this. If you look at A Berhad, which is an actual company, public listed company on Bursa Malaysia, if you look at its earnings, it has actually grown consistently over the long term. Sure, there are times whereby it grows much faster. There are times it might grow slower. But overall, over the long term, it should actually generate consistent growth in earnings. It's just that the percentage will be a little bit different over time. But over time, it grows. If the earnings of a company grows like this, then you can calculate CAGR. So this is step one. Make sure that it has a graph. Make sure that the earnings, the pattern looks something like this. Step one. Now, step two. Step two is actually to insert the figures. Now, this is actually a figure, let's see, 1 year, 2 years, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we have 14 years. But typically, if you want to standardize it, you can always stick to 10 years. Okay? So you need to actually, step two is about inserting the figures to determine what figures you want to key into the calculator. So if let's say we want to do 10 years, what happened is that we will take 2013, since the last one is 2023. So this is 10 year, 9, 8, 7, 6, 5, 4, 3, 2, 1. So this is actually the starting. This is year 0. Okay. So start year is year 2013, where A. Berhad has earned or generated 110.3 million ringgit in earnings. So this is start year. Earnings for 2023 is definitely end year, which is 438.1 million ringgit. Period 10 years. And with that, let's get into the calculator and let's see what kind of answers we can get from here. All right. So starting value is 110.3. So I just need to put in 110.3. Ending value is 438.1. So let's put in 438.1. And the number of periods, 10 years. So bam, let's do some calculation. And the answer is this, 14.79%. Ahmad Azri, correct. It is 14.79%. So which means to say from here to here, the earnings have been growing at a rate of 14.9% per annum. So that is actually the CAGR for A. Berhad. All right. So which means to say asset investor, okay, what kind of information I'm gathering? I am gathering the information that A. Berhad has a track record of generating consistent growth in earnings, and the growth rate on a compounded annual basis is 14.9%. All right, as calculated with my CAGR calculator. All right, so it's 14.79%. Okay, so which is actually confirmed in my next slide like this. Start year, end year, 10 years. Bam. Okay, so therefore 14.79%. So this is actually how you do, how you use the CAGR calculator to calculate the CAGR of A. Berhad's earnings. Now, let's look at another application for CAGR, where we can actually use CAGR to calculate the CAGR of A. Berhad's stock price. Let's take a look. So this is A. Berhad stock price. Okay, it is an actual public listed company in Malaysia. So this is March 2024. So I backtrack it 10 years. Okay, so as you can see from here to here, the stock price has grown. But you can see that the stock price in the short term has gone up and down. So in the short term, we can't really predict lah. All right, no point predicting where the stock price is going to go. It can go up, it can come down, it can go up a lot, it can actually grow very slowly. So the growth rate or the declining rate on a short-term basis is very volatile, unpredictable. Okay, so no point looking at things in the short term. But if you have long-term thinking, we can see that stock price has actually grown over the long term. And this, usually what I will do is that I will take this, I will observe this, and I will compare it with A. Berhad's earnings. Okay. As you can see, A. Berhad has actually increased its earnings over the long term. at least for the past 10 years. So the growth in earnings has kind of like reflected in the growth in stock price, or vice versa. Okay. So right now, if you have a stock price graph that looks something like this, which over the long term has grown, only with this pattern, we can then use this. We can actually calculate CAGR for this kind of company when it comes to stock price. Okay. So with that, let's use the calculator. Once again, we have the start year, we have the start, we have the end, we have the period. Period, no need to say, it's always back. We can always standardize by backtracking it by 10 years. Start value will be this, 0.95. End will be 3.85 because this will always be reflected. This will always be the latest stock price, which is 3.85. And with that, let's go back to the calculator and let's see what kind of CAGR we can actually calculate for Eberhard. So let's do this. Starting value is 0.95. Ending value is 3.85. Number of periods, 10 years. So the amount of CAGR, so the stock price has been increasing at a CAGR of 15.0% over the past 10 years. So the growth rates are different on a year-on-year basis. Sometimes it goes up very fast. Sometimes it goes up very slowly. There are times where it dips, but on a 10-year basis, it's 15%. Okay, 15% per annum. So that is actually the CAGR calculation for Eberhard stock price. Right? So over here as an investor, what I like to do is to actually compare the CAGR, the 10-year CAGR for the stock's earnings, and then I will compare it with its stock price. So in the case for Eberhard, I can see that the growth rate of its earnings has been more or less in tandem or in line with the growth in stock price. Or you could also say it vice versa, whereby the stock price growth or the rate that the stock price has been growing for the past 10 years, which is 15%, is actually in tandem, in line, or it kind of like reflected the growth in stock price, or it kind of like reflected the stock earnings growth over the past 10 years. Because 14.8% and 15% is more or less quite there, all right, about the same rate. All right. So that is actually the amount that we can get when it comes to Eberhard. So long-term earnings, compare it with long-term stock price performance. That's what we get. 10-year CAGR, 14.8%. For earnings, for stock price is 15%. Okay. I believe for investors of Eberhard, I'm pretty sure that they will be happy to actually see their money being compounded at a rate of 14.8 or 15% per annum over the past 10 years. All right. So think about this. Imagine your money being compounded at a rate of 15% per annum. Wow. How would that look like? Okay. Now, so which means to say, if you have 10,000 here, okay, so this is like almost one ringgit, right? You have 10,000 here. Right now over here, you should have close to 39,000 ringgit over here. So invest every $10,000 you invest in Eberhard. Right now, it is worth about 39,000 ringgit. And all this, we haven't actually talked about 10 years worth of dividends over here. And so you can see that in this case, the money in stock investing is not so much about trading. It's not so much about buying and selling. Rather, it is actually buying something that you know is profitable, that you know is working. You know that the fundamentals are actually quite good. and you just sit on it and compound your money at the rate of 15% per annum, excluding dividends some more. All right. So the money in stock investing is not so much about trading, but it's just waiting, making sure that you buy the right thing and wait. All right. So in this case, for Aberhard, that seems to be rewarding for shareholders who are willing to wait. And right now, let's move on to the third part where we're going to talk about PEG ratio. Now, PEG ratio is a very interesting ratio as this is actually more suitable, more of a ratio that is being used by growth investors. Growth investors means to say these are people who are willing to hold on to a good stock, sit on it, and wait for it to keep on compounding over the long term. So it's never about the short term. It's always about 5 years, 10 years, or even forever. It's like Buffett, right? Very long term. Okay. So as long as the stock keeps on increasing its earnings year after year, you don't actually sell. And PEG ratio is designated for this kind of investors. Now, let me share with you how to calculate PEG ratio. Okay, so there are some mathematics to do over here, and let's get into them. Don't worry, I'll guide you through how to calculate PEG ratio and how investors use PEG ratio. So assuming that there are 3 stocks to invest, we have A Berhad, B Berhad, and C Berhad. So we see that A Berhad, the stock price is 3 ringgit and 85 cents. B Berhad, 10 ringgit and 25 cents. C Berhad, 28 ringgit 97 cents. Now, the first thing about PEG ratio is to calculate PE. So we are handling the first part, which is the PE part of the PEG ratio. So let's start with PE, okay, which is over here. So how do we calculate PEG ratio? Well, we take the stock price and we divide it by its earnings per share. So in the case of A Berhad, we will take 3.85 ringgit divided by 30 cents, and therefore you will get a PE ratio. So guys, maybe you want to calculate, or maybe I should show you how to calculate PE ratio. Let me just open up the calculator function. So let's look at the calculator function. So let's start off with calculating PE ratio. Let's start off with the first one, which is A Berhad. So we have 3.85. We divide it by 30 cents. So there you go. You have 12.83. Okay, so you can put here 12.83. So that's A Berhad's PE ratio. For B, now let's do for B, yeah? Okay. So B is actually very simple. We take 10.25 divided by 0.72. 0.72. Bam, you have 14. All right. So some of you are getting 14.2. Very good. So put that down, 14.2. 4. Okay. Now let's look at C Berhad. C Berhad stock price is 28.97. Earnings per share 2.8. So let's do the maths. 28.97 divided by 2.8. So your PE ratio is 10.35. Okay. Which we'll get into the next slide. So therefore, this is where we are at right now. A Berhad PE ratio 12.83, B Berhad 14.24, C Berhad 10.35. Okay. So from an investor's point of view, based on PE ratio alone, we will conclude that their PE, their valuation is almost the same, whereby C Berhad is undervalued, more undervalued compared to A Berhad and B Berhad, because C Berhad's PE ratio is the lowest. Okay. So in terms of valuation, which is measured based on PE ratio, C Berhad is most undervalued. B Berhad is most highly valued among the three stocks. A Berhad in the middle. Okay. So this is actually the first difference. I wouldn't say the first difference, but the key difference between an investor versus other people. Because if it's other people, they will say C Berhad is very expensive because the stock price is 28.97, whoa, which is very high as compared to A Berhad, only 385. Okay, so don't get confused, yeah? When we talk about valuation, we talk about valuation ratios like PE ratio. We don't just look at stock price. Stock price is only there to tell you whether you can afford or cannot afford the stock. That's about it. So A Berhad at a lower price is just more affordable. Doesn't necessarily mean that it is any cheaper or any more expensive. It's just a price, okay? So right now we have covered PE ratio, the PE part of PEG. Next, with the PE ratio, we are going to insert the G into the PEG ratio. Here's how it works. Okay, so right now we have the PE ratio. And let's say we have calculated the compound annual growth rate of its earnings, okay? So PEG ratio is a ratio that considers two things. Number one, the earnings of the company, and number two, the growth rate of the earnings of the company. Okay. But growth rate is very subjective because growth rate, anyone can actually calculate. Let me just show you an example. Some people, because growth rate is it depends on how the investors use it. So like me, I like to use 10 years annual growth rate. So therefore, I calculate a 10-year CAGR. However, some investors will choose to use a 5-year CAGR. Some may even choose 3 years. So technically speaking, no matter how you look at it, all you need to do is just go back and use this calculator. From there, you actually compute whatever is most suitable or more, whatever is your preference lah. Let's put it that way. As long as the figure is realistic to you, that will be okay. But in my case, I tend to use 10-year CAGR. All right, because I like to have a much longer view of the stock. So therefore, I use 10 years. Now, coming to this slide, how do we calculate PEG? Very simple. What we do is that starting from A Berhad, PE ratio is 12.83. We take 12.83, we divide by 14.8. And there you go. You will have your PEG ratio. So I'm going to demonstrate to you by using this calculator. So we have 12.83, which is the PE ratio. And then we will divide it by the 10-year CAGR for its earnings, which is 14.8. So we take this, divide by 14.8. Bam, we have 0.87. So put there 0.87. Let's move on with B Berhad. So B Berhad, the PE ratio is 14.24, but the 10-year CAGR earnings is 18%. So 14.24 divided by 18%. So therefore, your PEG ratio is 0.79. So put here 0.79. Now, let's look at C Berhad. PE ratio is 10.35. The earnings CAGR over the past 10 years is 8%. So we will take 10, divide by 8. And you will get a PEG ratio of 1.29. So let's just put here 1.29, which will lead us to our next slide. So what can we see here? We can see that based on PE ratio, C Berhad seems to be most undervalued. Okay? Because this view is only based on earnings alone, just one criteria. However, if we use PEG ratio, where we are considering both earnings and the growth rate of its earnings, now we will see that, hey, B Berhad is most undervalued because the PEG ratio for B Berhad is the lowest among the three. All right. So in this case, how will we choose? Well, for my take, A Berhad, B Berhad, C Berhad. First and foremost, when I look at the PEG ratio, the PE ratio, what I see is that their PE ratio, although B Berhad is slightly higher, but it's not significantly higher compared to A Berhad and C Berhad. It's still within the 10, 12, 15 range, that kind of thing. So I will group them as pretty much similar. So over here, this is like round 1. Then I will move on to round number 2, which is to look at growth. If we actually add in one more consideration, which is growth, then I will see that, hey, A Berhad and B Berhad seems to be more similar in terms of PEG ratio versus C, whereby the PEG ratio for C Berhad is slightly higher. So in this case, what I would prefer, not necessarily correct, is that I would choose to invest in both A and B Berhad first. These two will be preferred over C. Okay, so that is actually how I look at PE and PEG ratio to decide which of the 3 stocks do I prefer to invest in. Okay, so that is actually how I make decision. Now, let me actually throw you guys a question. Let's say we have another 3 more stocks, D Berhad, E Berhad, and F Berhad. So D Berhad, we have stock price $50, $32, and F Berhad 15. So we have PE ratio, D Berhad is 20, E Berhad is 40, F Berhad is 60. And if you look at the 10-year CAGR, D Berhad growing at 20%, E Berhad growing at 40%, and F Berhad growing at 60%. Wow. So PEG ratio for all these 3 stocks, similar at 1. So we have a situation where the PEG ratio is similar, but then the PE ratio is so vastly different, 20, 40, 60. Guys, just want to hear from you. Which of these 3 stocks would you prefer to invest? Put in the chat box. So Huang says D. Siu Feng D. Okay, Siu Kim Man D. Ahmad Azri says the one with the highest AGR. So Alex D. Kok Meng F. Oh, Lily F. Yipwen F. Okay, Joey F. Ng Seng Hock D. John Yap F. Okay, fantastic. So now we have 2 schools of thought. Okay, so this is actually my take. Not right or wrong. It's all a matter of preferences lah. Okay. So personally for me, I will go with D. Why? Because my personality a little bit more conservative. Because I think that for a company to grow, its earnings at a rate of 20% consistently year after year is already quite remarkable lah. All right. This is actually more achievable than 40% and 60%. Okay. I'm not too sure whether I can find a company that can keep on growing its earnings, its net profit at a rate of 60% per annum for many, many years to come. I believe that this is actually quite hard to achieve. Okay. So for me, I will still stick with D. Berhad simply because of a few reasons. Number one, the CAGR earnings is more attainable than F. Berhad. And number two, PE ratio of 20 is more, how would I say, more assuring lah. It offers more assurance to me than to buy a stock where its PE ratio is 40 and 60. Okay, so I will still pick D. Berhad over E. Berhad and F. Berhad. So this is actually how I use the valuation ratio. So we have round 1 and round 2. Round 1 is PE, round 2 is PEG. So my first step is to ensure that whatever I do, the stocks must be consistently profitable. All right. The PE ratio will be reasonable. Don't try to go anything beyond 30. So anything beyond 30, I can scrap it off. So I will always be looking at stocks which is having a very reasonable PE ratio. Okay, maybe 20, maybe 25. Try not to go beyond 30. If it's below 20, like 15, fair enough. I can think that will be better. The lower PE, better. The lower the PE, the better. So that's round 1. Now, round 2 is, let's say when I have a pool of very good stocks and their PE ratio is, let's say, around 20, then from there, I pick the one which has a much lower PEG ratio. And how do I calculate the PEG ratio? You must first learn or know how to calculate CAGR. So CAGR helps you to calculate PEG ratio. So that is actually how all these things work in order to help me make better investment decisions. Okay, so let me just put it simply. To use CAGR effectively, the first step is to make sure that the earnings must grow consistently year after year. Then we calculate the CAGR. CAGR, you need 3 ingredients: start figure, end figure, period. Usually period is 10 years. Then the third one, calculate the PE ratio. Then finally, we take PE ratio and divide it by CAGR to calculate PEG ratio. Then you use this to compare with the peers or other stock deals that you are considering. Then from there, you can make the final decision. Last but not least, I'm going to just share with you guys some examples of stocks where CAGR cannot be calculated nor applied. Let's take a look. The first one is a company that looks like this, something like B. Berhad. So B. Berhad is a type of company whereby some years very profitable, some years not profitable at all. So you can see that the profit pattern looks something like this. It grows its profit, decline profit, grow profit, decline profit, decline profit, grow, decline, grow, loss, profit. This kind of stock, no way you can calculate CAGR. So what do you do with this stock? Typically for investors, you can just throw away this company lah. No need to put it into your portfolio. Why? Simply because if you are into calculating CAGR, you always want to include A. Berhad, as many A. Berhad as possible into your portfolio. Okay? You only want A Berhad. B Berhad, you can actually throw it into the rubbish bin. So no need to consider B Berhad. Type 2 is like C Berhad like that. You see this? For many years, it is profitable, but there's a problem. Although it is consistently profitable, but the problem with C Berhad is earnings keep on declining year after year. Last time it used to make 400 plus million dollars per annum. Over time, it actually reduces its profits. Now it's actually making about 200 million. Now, this is actually a problem simply because right now we are facing, due to rising cost of living, due to inflation. Why do we invest? We invest simply because we want to protect our money, the purchasing power of our hard-earned money, through compound annual growth rate, through CAGR, through growth. So when C actually reports a decline in earnings over the long term, it is not exactly a very good hedge against inflation. Okay? As a matter of fact, if you happen to invest in this kind of company, you are quite sure most of the time to lose money because the stock valuation would be revalued downwards. So it does not serve the purpose of sustaining the purchasing power of your money. The only type that can actually hold value is the type that can keep on consistently generate growth in profits. Something like A Berhad. If you have A Berhad, then you don't really need to worry about inflation. So this kind of company, even if you calculate, you're going to get a negative CAGR. Why do you want to have a negative CAGR in your portfolio? Doesn't make sense. The third one is even more, is something that does not even make any sense at all. It's where you buy a company that keeps on losing money. So for E Berhad, every year lose money. What for you invest in this stock? You invest simply because you want to have a share in the company's profits. But this company is not profitable, ma. So if it's not profitable, why do you want to invest? So for this company, no way you're going to calculate CAGR. And any company that doesn't allow you to have CAGR, you can actually forget it lah. No need to invest in this type of companies. All right. So what is the purpose of using CAGR? Why do we use CAGR, or why do investors use CAGR? If you know how to use CAGR, you will be motivated or encouraged to only focus on stocks that deliver consistent growth in profits for the long term. So it's going to be an inflation hedge or a hedge against inflation. It's going to sustain your value because valuation is actually very much earnings based. So higher earnings, more income, higher value, that kind of stuff. All right. So if you use CAGR, you're going to achieve more or less, be propelled to actually achieve that kind of results over the long term. And with that, thank you so much for hearing me out. And thank you so much for attending this sharing session or this presentation. Hopefully right now you are an expert in using CAGR when considering an investment in stocks. With that, I'll pass back the control to Shane. Shane, all yours.
Thank you so much, Ian, for sharing with us about CAGR. How do you use it? And what kind of stocks are suitable to use CAGR? What kind of stock are not? So if you have any questions to ask our speaker today, please write them at the Q&A box, not the chat box. Write them at the Q&A box. So the first question is from Ahmad Azri. What is a good CAGR number for earnings?
Good number. Depends on investors lah, huh? But CAGR is actually specifically for growth investors. So typically for growth investors, what do I mean by growth investors? Growth investors are simply a subset of value investors whereby they want to actually invest in a business that is profitable or increasingly profitable. And they tend to use these profits, right, to reinvest back into the business to generate even more profits. So dividends will be lesser part of a play, but it's more like the compounding value of that investment. So I would say for starters lah, for people who are into growth investing, a good CAGR will be at least 10% lah. That's what most growth investors believe lah. Of course, some would say 15%. You can actually put in whatever amount, but I would say for starters, above 10% will be good.
Okay. Thank you so much, Ian.
Mm-hmm.
The next question is, just now, did you mean that the lowest price to earnings ratio and the lowest PEG
Mm-hmm.
are better, are the best?
They are preferred, but no right and wrong answer. It's just I prefer them. You can say that lah. I just prefer stocks that have lower PE ratio, and among that circle of PE ratio, that pool of stocks, the one with the lower PEG ratio will be obviously preferred lah.
All right. So this typically value investor would like companies with lower PE or lower PEG. Just that, we need to watch out for, would that be a value trap, right? So it's something to keep in mind. Okay. So it's a case by case basis. So the next question is, how can we tell that if the company in the past 10 years has increased its earnings consistently, that it will keep on increasing its earnings for the next 10 years?
We can't, but I'll give you one analogy. It's like budak sekolah. It's like schoolboy, all right? Let's say we have a classroom filled with 40 students, and you know that inside the classroom, there's a few boys, there's a few girls, right? Whereby you know that their character are such that they are very positive, attentive in class, do their homework, and their exams are always getting, let's say, 90 marks and above. Okay? You can tell that is actually their characteristics, and that's what they have been achieving. The track record has been pretty good. Can you actually tell how much are they going to get for their next exam, or next 2 or 3 or 4 exams, or even their SPM? We cannot, okay, because we can't tell the future. However, we can roughly make a good guess based on their current status, their current homework, their current perangai, or their character, all right? Whether or not they are attentive in class, whether or not they submit their homework, and all these kind of factors lah, okay? And their consistency in their past results. So if you want me to choose between which one will get me 90 marks, is it this kind of student or another student who, sometimes can hit 80 mark, most of the time only 50 mark. Sometimes if he's in a good mood, he will submit his homework. Sometimes he doesn't actually submit his homework, or most of the time he just play a fool in class. I would definitely bet with the one that, has a good character in class to actually get me my 90 marks. So technically speaking, my viewpoint is of that schoolboy or classroom analogy lah. All right. We go with the character. That's why we always want to understand the business. We want to know how the company is run, the perangai, the attitude, the drive, the ambition, and the track record to back it up. And if you have this kind of character, very rarely you will get into value traps.
All right. Thank you so much, Ian.
Yep.
The next question is asking your opinion. Okay. Can you evaluate YTL power and help to calculate the CAGR for the earnings?
Well, the thing is that you guys have the tools, right? And typically, whether it's kclau.com or Bursa Malaysia, whatever we do, online courses, free courses, whatever, we don't actually give opinions, all right, as to what to buy or what not to buy lah. But you are definitely, I have actually imported the same tools. But what you can do is that, let me just share with you, since you are that interested, all you need to do is just go to Bursa Malaysia website. Okay, lah, let's go to the home. This is the home page. So all you need to do is just click company announcements. All right. If you want a shortcut, then you can just type in YTL. Let's say you like YTL power. So you just click annual report. So you will be given so many annual reports, right? So click the latest one. So you can book up. So you can open up the annual report like this. All right. As we wait for it to load, if you want a shortcut, just go into this 5-year thing. All right. So you can take profit for the year attributable to owners of the parent. This is shareholders' earnings. Copy this. We are given 5 years, right? 1, 2, 3, 4, 5, up to 2019. So 1, 2, 3, 4, 5. Click this. Open this up. Okay. So you have the financial highlights, right? Find this thing. Do again. 1, 2, 3, 4, 5. So now you have 10 years worth of figures, right? Then you plot a graph. See if it looks like Eberhard lah. If it looks like Eberhard, then only we can start calculating CAGR. Then that's how you do the CAGR earnings. But of course, if you want to do the share price of YTL Berhad, YTL power, so it is quite obvious that all right, Shane, maybe this is actually what interests a lot of people lah. It just went to the moon lah. Okay, so typically you can't actually just calculate CAGR like that lah, considering that it has a prolonged decline in share price and suddenly it just skyrocket like that lah. So based on this, I'm not too sure how you are going to input the start value and end value lah for this case. Yeah. With that, back to you, Shane.
All right. Thank you so much, Ian, for sharing your perspective. The next question is, do you use price to book ratio for company valuation?
Rarely.
Rarely. Okay.
Rarely.
Can you explain?
Because I will be more interested in the company's income generating ability over what it has in its balance sheet. To me, balance sheet means the company has $1 billion in cash. That is balance sheet. What is more important to me is every year, how much cash flow, how much earnings can it generate? It's one thing to have $1 billion in cash. It's another thing to have a company that keeps on generating $1 billion in earnings or $1 billion in operating cash flow. To me, my basis of valuation will be based on earnings and cash flow. So I prefer that over just looking at a balance sheet. Balance sheet to me is just to make sure that the company has cash. The company is not so geared lah, not so highly geared. The balance sheet is healthy. So I look at balance sheet in the light of sustainability, not valuation.
All right. Thank you so much, Ian. So the next question is by Sugasni. Which year is more reliable to use to calculate 5 years or 10 years?
Okay. Which year is more reliable? I'm not too sure. Usually the end year is always the final year. So it's just where is your starting point only. If it's 5 years, then you just backtrack. 1 year, 2 year, 3 year, 4 year, 5 years. Okay, so you're starting at 2018. So you can take this as your start year, end year, and then the number of periods, 5. Or is it 10 years? Then it's just a matter of preference. Or you can calculate both and then you decide what you want to do. What you want to do, which one you want to choose, or you want to choose the average between the two. So that one is up to you to decide. But if you want to be more standardized, you can, or you don't want to crack your head over which one to use, just use 10 years lah.
Thank you so much, Ian. Now we know that the high growth stock tend to have a higher PE ratio. So what is a typical PEG for high growth small cap company?
Well, I do not know. Okay, I do not know, honestly, myself. Simply because I have been out of touch of the small caps in this country. And the first and foremost, right, if you have a company that has been consistently doing this kind of earnings over the past 10 years, right, usually it's very hard for this kind of small cap to remain small cap lah. The small cap might actually grow and have been elevated and become a mid cap or a big cap already or large cap already lah. Okay, so which means to say, I will not be able to see what is a typical PEG ratio like. But put aside the numbers lah. Let's say you have A, B, C, and then your PEG ratio you calculate first. Then from there you kind of like have a data of several numbers. Then from there maybe you can choose the lower one lah. But I would say try not to go beyond 2 or 3 lah.
All right. Thank you so much, Ian. The next question is by Ahmad Azri. Can we use PER to evaluate indices such as FBM KLCI? Say 1,200 points grown to 1,800 points in 10 years to gauge whether it is undervalued or overvalued.
This one, I think a bit hard lah. Okay, not to say you can't, you can, because but then I guess it depends on you can actually use where's KLCI. Can we do this? KL's market. I'm not too sure whether Google Finance can actually do KLCI. But let's say you have S&P 500. And then obviously for this one, you definitely can actually calculate CAG. You definitely can calculate CAGR. All right, you can actually backtrack. So now it's March 30, 2024. You can backtrack to an approximate time. Let's say around somewhere here lah. Then from here, which is 1,008, 18, let's say round it up to 1,860. So 10 years ago, KLC, the S&P 500 is 1,860. And then right now is 5,171. So with that, let's see. So 10 years, huh? And then your CAGR for the S&P 500 will be around 10.8%. So in this case, so here to here is compounding at a rate of 10% per annum. So that is actually a simple calculation. But as to whether or not you can use this on KLCI, then you need the KLCI 10 years data. Then from there you see the pattern, then only you can decide on its calculation. It's the same formula. All right, Casey? No, sorry. All right, Shane.
All right, thank you so much, Ian. The next company is by Jun Xian.
Mhm.
What if a company which has been in consistent growth for the last 10 years or even 20 years suddenly experience a drop in their profit in the final year? So will CGA or compound annual growth rate be still applicable?
Oh, I like this question a lot. So this happened a lot, especially during COVID times, right? So this is actually a more case-by-case stuff. So there are companies whereby it has been very profitable for 10 years, 15 years, then suddenly COVID hit, boom. A lot of businesses shut down, a lot of businesses cannot operate or cannot operate normally. So what do you do in this case? Well, for me, I will actually exclude the odd year when it comes to computing the CAGR. Why? Because I know that year something happened. It's a funny thing happened. It's an abnormally. So when it comes, so as an investor, what is important is to assess the company in terms of its actual or true ability to generate income. True ability to generate income is about times where normal times where it's about normal times, normal business hours, everything is just normal. Okay. So what you want is to assess or value the stock based on its ability to generate income during normal times. During abnormal times, like market crisis, downtrend, COVID-19, or price war, or trade tensions, and all this kind of stuff, it causes all the stocks to actually nosedive like that. Then I will just omit that year. I'll just focus on CAGR on the normal years. Then from there, I can actually gauge. But typically, just to add on, usually at these times, right, when the profit just drop, and it depends on why is it dropping? Is it because of external forces like COVID? Or is it like or another type could be the company is slapped with a fine. Okay, so if the company is slapped with a heavy fine, and after they have paid the heavy fine, business still runs like usual, then no issues lah. Okay, so it's all based on case by case basis. Now, let's turn it the flip side. Okay, on the flip side, the most memorable example would be gloves lah. During COVID-19, gloves have been doing well, and then COVID-19 happened, boom. Okay, seems that glove demand is actually skyrocketing at that time. Profits actually like 5x, 10x compared to the last year. So how do you calculate CAGR? You also avoid that funny year. You also avoid that durian runto year because it doesn't make sense. It's like, let's say for example, okay, since we have the Bursa Malaysia kind of website, so let's take a look at one of the glove stock. Okay lah, don't want top glove all the time lah, very sian already. So let's look at Hatta lah. All right, let's change Let's change the flavor a little bit. Let me just download its annual report. Okay, so this is actually how it looks like. So this is its profit after tax and margin, right? So this actually represents 2020, 2019. This represents a period before COVID-19, which is at 454.9 million, 434.4 million. So before COVID-19, Atalaga has been making around this much lah. So this is under normal circumstances, 400 plus million. During COVID-19, 2.9 billion, 3.2 billion. Okay. So as an investor, how I look at it is, if you try to calculate PE ratio, or you try to calculate CAGR ratio based on this, wow, your CAGR will look so fantastic, which is super unreal already, because you know that this is not normal business condition. This is COVID-19. That's why there's a spike in demand. Okay. But can this spike in demand be sustainable for the next 10 years? That is actually something that investors should be evaluating. And of course, clearly here, the answer is no lah. So when if it's no, then of course, whatever figures, whatever valuation you put in will be erroneous, will be quite faulty, because your basis all salah, your basis are not so accurate. When your basis is not so accurate anymore, your CAGR is too much and it doesn't happen, then you will be disappointed with the results law. Okay. So it works in both ways. During abnormal business conditions, forget about that particular year's earnings for the time being. That's my take lah. All right, Shane?
Thank you so much, Ian, for the clarification on how do you use, CAGR on companies with extraordinary gains or extraordinary loss for that year, right? So the next question is by Siu Kim Man. Will this be more difficult to choose CAGR to evaluate for cyclical companies such as in the construction or property sector?
Well, we have to look at it from a case by case study, from individual stocks kind of thing. So we can't actually lump it up and say, oh, this one, all the stocks in this sector, tak boleh pakai, cannot be used. Doesn't work that way also lah. So we can actually so that's why we actually look at it on a case by case study, on an individual stocks basis. All right. So if you want to talk about cyclical stocks, whereby cyclical means maybe in the good times, wow, profit looks so nice. And then in bad times, wow, profit decline or even incurring losses. Then of course you can't use CAGR lah in this case, right? So that is actually a reason why investors may not want to actually invest in this kind of company lor. Because what do investors want? Investors want some level of if you want to actually enjoy a compounding effect for your money by buying right and sitting there and do nothing, you want a berhad. Why you want to bet on cyclical stocks, turnaround stocks, or all these kind of companies? So why make your life difficult in that sense lah? Of course, you will have more trades because you want to do the high level of difficulty, but for this case, for CAGR purposes, it will not be that applicable lah. Another case is that, let's say you have a property company, maybe a smaller one. It has a good profit growth simply because it is actually embarking on a few construction projects. Maybe it's developing a few condos and the condo is selling well. Okay, so for that few years, because of the condo sales, wow, profit goes up. But after the company has handed over the units to its buyers, no more project already, or lesser project, couldn't find land, or don't know what it does next. So then profits actually tumble down lah. So if you have that kind of company, also very difficult to use CAGR lah, or use CAGR. And it doesn't make sense to use CAGR on this kind of companies. So CAGR on project-based companies, whereby the revenue, the income is generated by projects, a bit difficult lah, if you ask me lah. So try not to use that on cyclical stocks.
Yeah, there's also my view is that CAGR on cyclical stock will typically be very low, because in the performance is, as what the name suggests, is very cyclical.
Mm.
I guess for me, right, the use of CAGR, if I use it on highly predictable companies, I will look at the longer term of years. For instance, if I look at companies that are of value based, they are blue chip based, big cap based, then I will look at 10 years. If I look at a high growth stock, small cap one, I will look at their profit for the past 3 years. So that's how I do it. Right, for growth stock, I'll use a shorter year because I think the recent performance would be more accurate for me to guess what would be or predict, forecast what would be the next year profit like. For a blue chip, I would typically use a longer tenure, like 10 years or so. So that's how I would use it. All right.
Mm.
So the next question is by Huang, is that we saw that just now Abraham's CAGR for the stock price and company earnings quite close. Is it true for most stocks?
The answer is not really also lah. Berhad just happened to be one of those stocks, but it's not necessarily that way. Okay. So there are situations whereby the earnings CAGR of a stock exceeds the stock price. If you happen to find that kind of stock, quite good also lah, which means to say you will find this stock to be undervalued because the growth of the earnings is actually faster than the stock price. Wow, very good this one. So even I will also be like, oh, there's such a stock then I will actually take a second look on this stock already. So that's one case. The other case is actually whereby the stock price growth actually exceed the growth of the earnings, which means you say last time, let's say the stock is actually earning at this amount of money, and then the PE ratio is about 15 or 20. Then 10 years down the road, the stock has actually increased its earnings, maybe double, but then the stock price increased by 4 times. Then for the earlier shareholders, that one is called congratulations. You have actually got yourself a good buy. All right. So that is actually your reward as a long-term investor. So not necessarily 14, like Aberhard, 14.8% stock price will grow at 15%. It doesn't work it doesn't work that accurate like that. Doesn't not necessarily the case.
All right.
All right.
Thanks, Ian. So the next question by Lily is that, is CAGR applicable in the financial sector?
It's not biased against any industry. So you can actually, the key requirement is not what sector. The key requirement is the earnings and the stock price. Then you can actually calculate CAGR. It's not industry specific, but you must have a company that is like Aberhard, then can lah.
All right, thanks, Ian.
Mhm.
So the next question is by Yo, is what are the differences between return on equity versus CAGR?
There are two different things. Okay, two very different things. Return on equity is where you take the earnings, you divide it with the shareholders' equity times 100%, that you get ROE. So ROE is to measure the efficiency. how efficient is the company in using shareholders' equity to generate earnings. All right. So it has nothing to do with, very little to do with, can't just compare it like that lah. So a company where its return on equity is, let's say, 10%, which means say for every $100 in shareholders' equity, it is able to generate $10 in profits to its shareholders. So of course, the higher the better. If you have 10%, it is definitely better than another stock that is only generating 5%. So the higher the better. CAGR is actually, or CAGR is actually used on multi-year, multi-years. So it's like 10 years period. We want to see whether there's any growth in the company's earnings. That's why we calculate CAGR. So that is the difference.
Okay, thanks, Ian. So next question is in relation to the tech industry. So in your opinion, can CAGR be used in tech industry in the past in Malaysia? For instance, for the past 5 years, it has been very overwhelming for tech. And the past 2 years, the tech sector was coming down. So it's not constant in generating earnings. So what is your view?
So since it's not consistent in generating earnings, then cannot lah. But the thing is that tech is like I said, it's not industry specific. You definitely can use CAGR on tech, no problem. But the thing is that like me, I'm not too good in tech. All right, I'm not a techie. So the thing is that, let's say a company has been doing well in producing a product or maybe a technological product that is well accepted by the current market. So the question is that the problem with tech is, can this company keep on generating, keep on producing the next product, the next product that is still going to be highly accepted by the public in the future? That one is something that you have to make a guess. You have to actually be a judge for yourself. And I couldn't actually be a judge for that simply because I'm not a techie. All right. So if you ask me about, hey, this consumer product, okay lah, maybe I use the consume, maybe I am a consumer of that product, fine. I can visualize how the business model works for that stock. Then I will have more assurance to actually invest my money in that company. However, so the whole nuances is to invest only if you understand something lah. So if you happen to understand some tech and you know that this is actually workable and you find that this company can actually generate more revenues, more income by producing more of this high-tech stuff, and you have confidence in that company, then of course you can go ahead and use CAGR to assess whether or not this is the type of company that you want to invest in lah. No problem.
Thanks, Ian.
Mm-hmm.
So let's do one last question because I think time is running out. So do you have any tips to avoid value trap?
Yes. The first one is to always look at the company's fundamentals. Means to say you need to understand the business model of the company. Then you look at the financial track record. Okay, you don't just look at the. It's not nice to name names lah, but some companies, they may actually give you good profits like this. My way to actually assess if these earnings are legit is to actually look at operating cash flow. So I also want to look at its accounts, not just its income statement. I also want to look at its cash flow statement to see whether the stock is cash flow generative. If the stock is both profitable and operating cash flows are good, very good, then very unlikely this will be a value trap. But of course, some companies' earnings keep on growing, no cash flow one, always want to raise money from investor, always want to borrow money from the bank, then something is very wrong. Okay, something is very wrong with that company. Okay, then I will be a bit suspicious about the company's financial accounts. That I will gracefully avoid investing into these companies. And for this kind of companies, doesn't matter what PE ratio, dividend yield, or PEG ratio, just avoid it altogether. Because if the fundamentals are not right, no point looking at valuation already. All right, so for me, my take on avoiding value traps is to put a priority on the stock's fundamentals.
Thank you so much, Ian. So we shall conclude our Q&A session now. So just let me take over the slide control. So ladies and gentlemen, you just heard from the co-founder of DividendVault, Mr. Ian Tai. Thank you so much, Ian, for sharing your wisdom or ideas in how do we use CAGR.
Oh, thank you so much. My pleasure too.